we've seen so many real estate investors saying, where's another tax-advantaged alternative investment that I could participate in? More and more of them are migrating over to franchising. So that's been a huge trend, I would say.
Welcome, everybody. This is Buck Driver with the Wealth Formula Podcast, coming to you from Montecito, California. And before I begin, I want to remind you that there is something called wealthformula.com. It is the home base of the Wealth Formula Podcast. So if you want to go check that out, check out the resources. One of the things you can do there is sign up for the Accredited Investor Club, aka Investor Club. See opportunities, deal flow that you might not otherwise see because they are private. As we get here later in the year, more and more opportunities, particularly for potential tax mitigation, lots of real estate, some other real asset funds that I think you may want to learn about. So go to wealthformula.com, sign up, and get onboarded. This is building a little bit on last week when we talked about how the wealthiest people in the world, typically, unless you're like an entertainer or professional athlete or whatever, you're typically going to get there through business ownership or real estate, right? Of course, we talk about real estate here a lot, and we have a lot of opportunities coming through on Investor Club. But, today I want to focus more on that whole business ownership concept, because I think it's something that probably more people could be involved with. But if you do want to be in business, so there are a few different options, right? So one is to start a business from scratch. I've done that a few times, and I'll tell you, sometimes it's worked out really, really well. And other times it was a total disaster. But that's the reality of startups. They require certain wiring too. An appetite for risk and the ability to kind of move forward without much of a safety net. By the way, speaking of safety net, it's much harder to do when you're 52 and have 3 kids heading to college and alimony to pay, by the way. Ask me how I know that. Anyway, another option, if you're interested in the world of business, is to buy an existing business. The advantage here is that you're stepping into something that already has worked, which gives you confidence in the viability of that business, right? It's a little bit, if something's been around for a few years, for 10 years, well, there's a pretty good chance you could keep it going. But it's not without risk, because some businesses depend heavily on key people or relationships that might not transfer. And then there are, businesses that can truly run themselves out there too. Those are great to buy. The only problem is they tend to be very, very expensive and out of the reach for people. So the third option, and I'm sure there are others too, but the third option I'm going to talk about, again, we've talked about it before, it's franchising, right? It's not risk-free either, but it does give you a roadmap. If you're the type who can follow a proven system, your chances of success go way up, right? So, and this is actually an interesting thing, because I think about the types of people who listen to the show, and a lot of you are highly successful students. So a franchise is kind of an interesting way to look at, business, because then you're basically studying what other people have already done and you're mastering it. And you're already really good at that. You're not starting from scratch. You're plugging into a model that's already been tested and supported. So, for people who don't necessarily have that, have the renegade startup personality, but want more than just a paycheck and index funds, franchising can potentially be a really great fit. And again, like we talked about before, if you get into this world, there's people who own tons of franchises who end up becoming really rich, just because, they can sell like a bunch of them and stack them up and get them going. But again, we've talked about franchises before. I just wanted to make sure this is sort of, again, on your radar as an option. So this week's episode is kind of bringing a perspective from a guy who's an expert in non-food franchises. We'll have that interview right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is John Ustinson, CEO of Franbridge Consulting and one of the nation's top experts in non-food franchising. He's a former franchise president, a Fortune 500 executive, and now a best-selling author and consultant who helps investors build semi-passive income through scalable businesses. Welcome to the show, John.
Hey, Buck, excited to be here.
Yeah, and apparently John is a listener of the show too, so that's helpful. He kind of knows what we're about and what we talk about on the show, so that's great. John, you've been I guess a Fortune 500 executive, a franchise president, and now you run your own consulting firm. How did that journey bring you to focus specifically on non-food franchising?
Yeah, Buck, I like so many others, when they hear the F word franchise, immediately thought fast food. And I spent many years in the corporate world, had a great run, but franchising was not on my radar because I didn't want anything to do with food. And really is when I had the opportunity about 8 or 9 years ago to step in as president of Shelf Genie franchise system that I realized, hey, there's a whole world of franchising outside of fast food. And, I really fell in love with the franchise model through that experience and just saw how all these diverse backgrounds could come together under a shared system of support and become successful business owners. So yeah, long story short, ended up becoming a franchisee myself of a number of different brands, still am today, and started my consulting practice about 6 years ago to help others get plugged in. And I'll start by saying we've got nothing against the food guys. We need them, but in my humble belief, there's simply easier ways to make money, and I'm happy to go into the reasons why.
Yeah, why don't you kind of tell us a little bit about that? I mean, just the differences, and you talk specifically about sort of specializing in this non-food world. I mean, what's the big difference there?
Yeah. You can do really well with food if you're in with one of the big brands, but oftentimes if you get in with a smaller one, there's just a little more risk associated with it. Consumer whims oftentimes change. I joke the frozen yogurt was big until it wasn't, right? And so that's a piece of it, but you're really making a big CapEx investment in most cases. Those are not cheap to get into. And then once you're in it, you've got, long operating hours, a lot of hourly employees. Oftentimes the margins aren't that good. So when you put that side by side with some of the opportunities that we go deep in, things like home and property services, health and wellness businesses, B2B services, businesses that cater to kids or to pets or to seniors, I'd say the general theme out there is understandable cash flowing businesses. That's what people are gravitating towards. And food just has a lot of moving parts and a lot more complexity. So most people that we work with say, hey, we want nothing to do with food, but we want to go deep on these other ones.
I want to ask you some very practical questions because I think, we've discussed franchises on the show a few times. And I think people are still a lot of people are interested, but, they kind of want to know a little bit of the nuts and bolts, Can you give us a little bit of a sense for, when we talk about non-food franchises, you mentioned they might be a little bit less expensive to get into than food franchises. What kind of investments are we talking about? I mean, for someone who's, high-paid professional, obviously you've got some capital, but you also don't want to spend all of your investable capital in 1 year on a franchise because inherently, it is a business. It may have a higher likelihood of succeeding than a pure startup, but there's still possibilities of failure. So, what are we talking about in terms of startup costs for your typical non-food franchise that people can expect?
Yeah, and some of these non-food categories aren't cheap, right? I mean, we just had clients that bought 10 trampoline parks at $3 million each. You do have some large ones, but I'd say probably 75 to 80% of those that we work with, when you look at the franchise fee and the startup cost and several months of working capital all built in, your investment range is oftentimes in the, I'd say $200,000 or $300,000 ballpark in most cases. If it's more of a larger customer-facing retail play, then it might be a little bit larger, 400,000 or 500,000. But a lot of our clients are gravitating towards more service-based businesses, where you can get in, maybe get multiple territories for that 200,000 or 300,000 mark. Some people are using all cash to fund it. Most are using SBA loans where you put in 20%, you fund the other 80%. Banks obviously prefer lending to franchises. Some are using a retirement rollover. It's what's called the ROBS program, ROBS, where you can roll over and you have to purchase the business as a C corp or set it up as a C corporation, purchase it with a retirement plan. You can pay yourself a salary. Some use that in conjunction with the SBAs. There are a lot of ways to make it happen, but no, you're exactly right. I mean, business ownership, there's a reason why you can make inherently larger returns. It's because you're also putting in a little more effort and there is risk associated with it, right? Franchising does de-risk it in a lot of ways. You look at the sheer numbers, but at the end of the day, it does take effort. And I always tell people if it was easy, everyone would be doing it, right? But it's obviously something the government incentivizes. They want you creating new companies, new jobs. And so there's a big tax play with it as well. But yeah, no, it's not easy.
And when you talk about tax play, you're just mostly talking about like bonus depreciation, that kind of thing, or?
Well, yeah, if it's heavy CapEx business, so certainly Section 179 and the whole bonus side with the new tax bill that gets extended. But no, it's things like, I mean, for me, I pay my kids in the business. Now they're all elementary age, but I'll put them in my ads. They'll ship my books out, that sort of thing. I then take some of that, roll it into a Roth IRA for each of them. The other part I pay myself back for private school tuition that I'm paying stuff. There are things you can do if I get a tax write-off for the business. Certainly all the home office and travel expenses, can be justified as write-off. So there's just a lot of things that as a high-paid W-2, you don't have access to in the tax code.
Yeah. Do you think, obviously when you look, I've sort of looked through franchises in the past, not too seriously, but just to kind of get a sense. But is it your sense that the more safer, the more stable, the better likely to hit franchises generally tend to be more expensive?
Not necessarily. No, I think a lot of it comes down to the model, how much equipment is needed, whether you need a retail storefront, how many employees. No, I'd say the franchise fee, what you're actually paying the franchisor, is pretty consistent across the board. Franchising is like every other industry out there in that you've got good players and you've got ones that are not as strong, ones that don't provide as good of support. And that's where we come in to try to help identify the strong ones. But no, it really is similar. Franchising is not right for everyone. There are people that we work with that I have to explain, you're too entrepreneurial. You want to put your thumbprints all over it. It's not a good move for you. But if you have some degree of humility and you recognize you're not always the smartest guy in the room, I think it truly is a better path to business ownership for most people. So, but again, it's not right for everyone. Not everyone's cut out to be a business owner. We see all types.
You mentioned SBA financing. With these kinds of things too, there is, when we talk about cost, there's really the upfront cost, but a lot of times it takes a year, 2 years to get something up and running, right? So how do people deal with that? Because they've got a lot of, they're carrying a lot of cost for a long time.
Yeah, I've had multiple conversations on that topic already this morning, and everyone's situation is different. But I always want people to go in eyes wide open. We have a whole discovery process where they can really ask questions, learn more, talk to existing franchisees in the system, hear about their ramp up, what that was like, what their profitability looks like. Certainly the franchisor has their financial representation. But I always tell our clients, let's go conservative and assume it does take longer to get to the break-even point, to that point of, I call it the oxygen of profitability, where you have that monthly P&L that's in the black. So no, a lot of models, you may not hit that profitable month until month 6 or month 9, the 9th month, or even a year into it, depending on the business.
Yeah.
There are some
sometimes it's and then sometimes it might just take a year to even set it up, right? I mean, that's pretty typical to go from soup to nuts and to starting in about a year.
From your first call with the franchisor, I'd say the process usually takes about 2 months to get to that point of signing the franchise agreement. From there, if it's a retail business, then it is going to take site selection and build out, which takes time. Typically it's not a full year, but sometimes it can be. Oftentimes, if it's a service-based business, which at least half of those who we work with are getting into, I'm happy to give examples. If it's a service-based business, you can be up and running oftentimes 2 or 3 months later. So it does condense the time period.
So we're talking about this in the context of maybe diversification, also, in the context of saying there's, this is an earning opportunity. I know we're calling it semi-passive. But in order to do that, you have to justify that with the type of returns you're going to get. And I know you can't really give projections in general, but how should people think about this in terms of, if they're getting, 8% in real estate and, right now in the stock market, people are getting a lot more there. Obviously, that's a volatile situation. It always is. How do you justify this to somebody that's what they typically do?
Yeah. The juice has to be worth the squeeze, right? For the effort that's being put in. Absolutely. And I personally invest in real estate directly and through syndications and energy funds and private credit. I'm an all of the above guy. Myself and a lot of our clients are too. We like the role that business ownership does play in the portfolio. That being said, most franchises will market themselves as, you can be an owner operator running the business day to day, or you could be semi-passive. Some call it semi-absentee. Some call it executive model. The idea there is that you put a manager in place day one to run the business. Now, my preference is to call it semi-involved because I think that's a better term for it, because you're not going to outsource the running of your business entirely, right? And if you don't have the right person in that seat, you're going to find yourself leaning in until you do. So countless case studies we have of clients who are running the business as executive model, but they usually weren't on day one entirely. It takes a little while till they get to that point they can really pull themselves back. So I always want to give that upfront disclosure. But no, from a return standpoint, some of these property services franchises, as an example, you're all in investment, call it $200,000 in round numbers. A lot of these businesses can then return $1 million in revenue, oftentimes at a 15 to 20% bottom line margin, sometimes even north of that. So let's just call it 20% for round numbers. That's a $200,000 payback. Maybe it's year two, it's not necessarily year one, but you'd call that 100% return on your invested capital. Now, again, you're putting in effort. That's why you get, an outsized return. But it's interesting. That would be 100%. And you're building an asset that you're going to be able to sell one day as well. So when a lot of times people are looking to leave their W-2 jobs to run a business, and they say, well, I'm making, $400,000 in the corporate world. I can only make, $250 here as a business owner. But then when they start layering the tax benefits they get and the fact that they're building an asset that they're going to be able to sell one day, it starts to justify it.
Yeah. Let's talk a little bit about, what it looks like. Again, just a review, what does it look like to be somebody who owns a franchise? You go into one of these, you sign your franchisor agreement, you're going to essentially, probably for, at least 6 months, you're going to be like getting something up and running, right? A lot of times people will be hiring managers and stuff like that at that point. What's the typical route? Like what do you see like people doing? Just putting people into the shoes of somebody who's going into this process. What does it look like?
Yeah. So first off, at the very beginning, I encourage people to date around, to have conversations with multiple brands. We usually have our clients evaluate a dozen opportunities that are available in their area. That's where the magic starts happening. You start to prioritize the characteristics you like in a business or don't like, and compare and contrast. They'll usually pick 3 or 4 to talk with. So again, once through that process, they decide on one to move forward with, they sign the paperwork. All right, what happens next? Typically, the franchisor has almost like a checklist of things that they're doing on your behalf and things that you need to do in the months leading up to that launch of the business. And again, it depends on the type of business, but part of that would be training. You'll probably do some online training. You'll probably get with the franchisor in person for a period of time at their home office. Maybe that's a week. You're able to talk to other franchisees in their system. It's kind of this built-in mastermind where you're exchanging best practices, learning from each other. Hey, where did you find your people? Hey, how are you compensating them and incentivizing them? And so you're able to take the franchisor's job profile and then kind of layer in some real world experience from other franchisees to go out and find that team. You know, and I'd say start doing some secret shopping too, you know, get to know the competition. How are you going to differentiate in the market, along with the franchisor's training? So, you know, if we're getting really brass tacks here, let's say it's a service-based business, you would then run some sample appointments with friends and family, get your feet wet, get used to it, and then, or have your team do that, and then, you know, start launching to the market. But the franchisor is going to be running a lot of that opening marketing that's going to make the phones ring, draw people in. Usually it's kind of a franchisor is handling a lot of the digital marketing, and if they're saying print, that sort of thing. And then you're handling a little bit more of the organic. You know, maybe that's doing some networking, getting involved in the Chamber of Commerce, getting word out there locally on social media posts. So it's a combination of the two. But the franchisor is there for support. And I think that oftentimes it does get overlooked, that community of other franchisees. It's cliche to say, but you're in business for yourself, not by yourself. There's a group of people that are living the same thing day in, day out. And so you really are learning from each other. And the more you lean into that, I think it fast tracks your success.
Is there ways to find out, like, this is, I'm assuming all under NDA, but data in terms of which franchises, I think the big thing that anybody who's going to get into this is like, okay, I'm going to put a bunch of money into this and then it's going to fail. And I don't want that to happen. Of course, there's no guarantees to that. However, is there data to show in any given franchisor if they, what their track record is in terms of, they've started 100 of these and 98 of them did well, or 75% did well, or something like that. Is that data available?
Yeah, every franchise system has what's called an FDD, franchise disclosure document. It gets updated every year. Typically in the April-May time period, they'll come out with a new one and release it. And, they have audited financials in there. They've got to cross their T's, dot their I's. I mean, there's a lot of legal liability if they don't do it right. So, it's full disclosure. There are 23 sections within it. There's what's called the item 7, where it's your all-in investment range broken out. Your item 19 is where they break out the financials, historical financials of franchisees. Now, it'd be great if everyone did it in the exact same format. They don't. And so, usually you get good information from the item 19. It's audited. Typically, you still have some questions after you review it. A franchisor typically does not have their P&L of all their franchisees' locations. So they'll show the corporate P&L to show how the model is set up. But then they'll show the revenue of all their franchisees. And so you kind of extract that pro forma on your end, as well as getting to talk to other franchisees in the system. But no, to your point, there's a section in the FDD where they do talk about any openings they had, any closures that they had. They list the contact information for all the franchisees. And so, again, you have historical information, but also resources that you can reach out to learn more.
How about, you mentioned, obviously, you have an asset that you can sell. What if you're looking to buy an asset? Like instead of skip the startup process? I mean, how does that work? If somebody's like, yeah, I like the idea of this, but I want to skip the, startup thing, and maybe I'll get a little bit less return, but that creates a lot more potential stability. How does somebody do that?
So within the franchising lane, we do handle resales of franchises. It's a small percentage of what we do. And here's why. It's not that there's not demand out there for the resales, but there's lack of supply. So what happens is franchisee decides they want to sell their business. The most likely buyer is another franchisee within that system. It's what I call internal M&A. They're going to get first rights, essentially. And that's a way for other franchisees to expand. So oftentimes those good deals, if it's a good one, it never hits the open market. The only ones that hit the open market are ones where maybe someone bought and never did much with the business, right? So there's nothing to buy. And so as a result, we just don't have a lot of supply for that. But that internal M&A is really common. And Buck, it's interesting. There's so many thought leaders out there today talking about buying existing businesses, buy and build, and and that can be a great proposition. However, here's what I see from where I sit. I have people reaching out every day saying, "Hey, we've been looking for existing businesses for 4 years, 5 years. We hired an analyst full time to go find businesses for us. Due diligence didn't shake out. Someone else outbid us." I continue to hear the same through lines over and over again. All of that time they could have spent building a business, right? And so it just takes a lot of time to find that right business. And even once you find it, there's inherent risk to it. You're assuming everything on paper is going to continue as is, But whenever you inherit someone else's team and culture, you're going to lose some key employees or key customers. It's almost inevitable. And here you paid a premium for that business. So it's interesting. I had conversations with a couple of past clients this past week who bought franchises with us 2 years, 3 years ago, and are now returning for their next round, their next purchase, to build off of what they've already started. So again, they didn't spend all this time looking. Instead, they got in the game, started building, knowing that's not the only thing they're ever going to do, but let's start it with a good foundation that we can always build off of by acquiring other franchisees, by starting our own business, by buying another business, but they kind of buy some time while building.
Yeah. The one thing I was going to ask you is that, you've sort of got your finger on the pulse of what things seem to be working, what not. What sectors of non-food franchising are showing the most promise right now?
Yeah. I just finished speaking at a private equity conference the other day where the feedback was, the private equity firms were saying it's sexy to have a franchise in their portfolio now. They love the model. And most of them are gravitating towards things like home and property services, sometimes non-sexy, non-trendy businesses, things that AI is not going to replace. Maybe AI will enhance how you do something versus the low bar competition in a given niche. There's just so many niches in home and property services that people oftentimes overlook that they love. Some of the businesses I'm invested in, I have an asphalt paving and line striping franchise, that parking lots. I've got another one that provides temporary walls around renovation projects and construction sites, kind of like an equipment rental type business, B2B. I've got another one that, provides custom pull-out shelving, in your kitchens and pantries. And then I have one in the health and wellness arena that provides custom orthotics, so 3D printed orthotics for people. So I would say property services has probably been the number one out there in the market for diverse backgrounds. We have lawyers and doctors and corporate executives with no experience in the space, but saying, hey, I see an opportunity. I'm going to follow the playbook that the franchisor provides and go down that path. Health and wellness is big. The theme is, what are people going to spend on regardless of the economy? And so it's everything from kids, youth soccer and tutoring to pet grooming to in-home senior care. There are a couple in the senior space that we really like outside of in-home care where you don't have to have a large team. It's more of consultative type positions, like you're the expert in your community on all the senior facilities. You're a placement consultant, or senior fitness, where they bring you in. You have a team of trainers that goes around to different facilities and trains and helps with stretching and exercise programs. So there's just all these different niches that you wouldn't think about unless you saw them right in front of you.
And you know what I like about what you just said too is I always tell people I'm a former cosmetic surgeon, right? And I've had people go through franchising and stuff like that, and they start looking at these beauty businesses and stuff like that or whatever because they sound a little bit more sexy. And my impulse is always to be like, boring, please keep it boring, because it's like you don't want something that is just people can cut out of their lives the second the economy goes south, or that they just don't need, and that there's enormous competition in. Those are the kinds of things that you're looking at when you're focusing on what to do.
Yeah. I joke that non-sexy is the new sexy when it comes to business ownership. It really is. And that's what people are looking for. And we work with a lot of doctors and physicians and dentists, and they want to do something that stretches them intellectually. And they love that idea of being a business owner, and franchising is just a perfect fit for a lot of them. But most of them are not looking to stay within health. They say, we're passionate about this, but we want to do something different. They'll get into a restoration business or a gutter business or things that aren't going out of style. So that is a very common thread, exactly what you brought up, that we want a business that's going to do well regardless of the economy.
Yeah. Yeah. How, tell me a little bit about what, today's macro trends, how that's affecting everything. We've got tariffs, we've got high interest rates that might start ticking down, but who knows? We're looking at a labor market that looks kind of very suspicious for recessionary, or at least, a contraction in the job markets. And then, as you mentioned, AI. So what are the macro trends that you think about when it comes to this kind of thing? How do they affect some of the decision making?
I'd say in the industries that we focus in, tariffs haven't had as big of a play. Interest rates have, and where I've seen interest rates play out, we've seen clients do as many SBA loans as ever. It hasn't really affected that. And of course, that's tax deductible interest. Where we've seen interest rates is real estate investing. Obviously, the real estate market has slowed down. There aren't that many great deals to be had. We all know the macro story there. We've seen so many real estate investors saying, where's another tax advantaged alternative investment that I could participate in? More and more of them are migrating over to franchising. So that's been a huge trend, I would say. Another thing on the labor market, I mean, the Wall Street Journal has an article at least every 2 days, if not every day, on AI displacing jobs and how these big companies are, broadcasting and proud of how they're doing more with less headcount, right? And so where I sit, it's on the ground in all these communities all across America. I'm hearing the same thing. I have so many mid-level and upper-level clients. They have a background in technology or they've been in consulting. And so many of them are gravitating and saying, hey, we know our days are numbered. Or, all of a sudden we're having to manage a team twice the size without any increase in pay. We're having to do more with less. I had a client today that said, hey, I've got a great technology background. I've been doing technology recruiting forever. I don't want to learn the whole AI space. That's a different ballgame for a younger man. So it is interesting. You see these through lines, and a lot of them are saying, I don't want to go work for another firm. I'm ready for a pivot, the P word, pivot, and they're coming our way. So I'd say that's the other big trend that we're seeing, people looking to make that jump.
Yeah. I'm surprised the SBA loans are still as, that they're as hot as they, obviously they're very favorable in terms of loan to value, or I'm sorry, they're loan to value, but interest rates, man. I was looking at acquiring a business not too long ago, and I was just like, interest is so high. All in, when I was looking at it, it was going to be close to like 10%. And I'm surprised that doesn't make people, think twice.
I'd say at first it probably did, but I think we've become used to it and maybe we've become numb to it. So 10%, you're exactly right. That's what we're seeing out there as well. Again, that's tax deductible. I keep going back to that, but that kind of nets you down to call it 6 or 7%, right? In most cases, you can pay that loan back early once you're cash flowing. So it's temporary in theory. But people like the idea of leveraging. And again, a lot of those real estate investors are used to leveraging.
Yeah, of course. Great. What else have I not asked you that you think would be useful for this audience?
Yeah, I think we hit on, the macro trends, a little bit about the financials. What I found is it just gets people excited when they start looking at real opportunities. I said, most of our clients will look at a dozen or so businesses. We'll share with them, the top ones in their market. 9 times out of 10, they end up purchasing something in an industry that was never on their radar. So I think, again, going back to, there's so many niches out there. And the challenge is if you start Googling, you're going to see a top 50 list or top 100 list of franchises. Companies are paying to be on that list. So there's just so much noise out there. And so that's where we come in. And I think, our model, Bucket's entirely free to work with us. We get a referral fee from the brands. None of that's passed on to our clients. So it's very much like a real estate broker. And we love helping. So no, I think you did a great job of kind of hitting on all the main topics that I would have mentioned.
How do we get in touch with you?
Yeah, come out to our website, franbridgeconsulting.com, FRAN bridgeconsulting.com. We'd also love to share a free copy of our book, Non-Food Franchising. It can be a great resource to read through. So just share your email address out there and we'll send you links to the book to download. And if you'd like to take a next step and book a call, we'd be happy to chat.
Fantastic. John, thanks so much for being on Wealth Formula Podcast today.
Enjoyed it. Thanks, bud.
You make a lot of money, but are still worried about retirement. Maybe you didn't start earning until your 30s, and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for, and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. And again, I think the moral of the story here in the last episode or two is that if you want a different life, you have to do things differently. If you want a different level of wealth, you can't do what you're doing now. Figure out, what it is that you want in your life, and then look at where you're at now and see if you can draw a straight line. If you can't draw a straight line, then you got to figure out, all right, well, what do I got to do so that at least I have a trajectory to even have a chance of getting to where I want? That is the moral of the story, and that is it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.